After 3 years of aggressive buying, foreign portfolio investors slammed brakes in 2022 and withdrew 1.21 trillion rupees from the Indian stock markets. The sellout was more aggressive in the first half. Overall, the market is on course to witness the highest ever FPI outflows in any calendar year. So, why have FPIs turned negative on India in 2022? Bhashwar Kumar brings you the answer.
India, which is being seen as a bright spot in a shaky global economy, saw foreign portfolio investors turning net sellers in 2022. They had been net buyers in the previous 3 years. So far this year, FPIs have pulled out 1.22 trillion rupees, or almost $17 billion, from the Indian stock market. In fact, they are on course to pull out the most in any calendar year. There are several reasons for FPI outflows, from interest rate hikes by major central banks to fears of a global recession. Investors have become more risk averse because of rate hikes and monetary tightening by central banks, including the US Federal Reserve. They have been skeptical about whether policymakers will be able to tame inflation without triggering a recession. Amid tightening by the Fed, the US bond yield has risen sharply from where it stood at the start of the year. The depreciation of the rupee has also added to foreign investors' nervousness. A fall in the rupee eats into the returns of FPIs. Another reason for a pullout is the spike in commodity prices caused by supply disruptions due to the Russia-Ukraine war. Against this backdrop, what do market experts see as the most important factor behind the outflow?
The central bankers, as they started tightening and started pulling out money, which they have probably started pulling out like close to about $1 trillion has gone out of by way of, I think, the liquidity suck out that they have done. The obvious impact is on the interest rate. From a 0% interest rate territory in US market or negative interest rate territory in some of the European and Japanese market, today most of the countries have actually entered into the positive interest rate territory, which means I think US today is I think around 4% kind of interest rate. In my viewpoint, I think this is the single largest factor for the FIIs to pull out money from equities and start putting money into debt because of I think this sharp rally into the debt pricing that they have seen in last few quarters. Otherwise, and this particular FIs which you are counting on, they are actually ETFs. They are the traders. They trade across asset classes, and they would probably, in a given situation, when they see the rally which they saw in the last 2 years, they put money into equity. Today, I think they are seeing the opportunity into debt, so they are pulling out money from equity and putting this money into the debt. Who knows tomorrow if I think debt starts becoming relatively less attractive and saturated? Quite possible that going forward in subsequent 2 quarters or so, they would probably start once again putting this money back into equity.
Also, amid the outflows, is there any trend that has stood out?
I think the main reason for FPI outflow is the strengthening of the bond yield. And because of that, I think they've switched over from equity trading class, I think, to bond trading class. So that is where I think they've switched money from equity to bond, largely for the purpose of trading. I don't think that any fundamental investors or the long-term investors from the FPI side has exited the market. On the contrary, I think we are seeing systematically inflow of money into the FPIs from the deals which are basically fundamentally driven or long-term investment driven. Long-term investment climate has not changed. On the contrary, if you notice the larger amount of investment deals which are happening in the country, particularly in the area of PLI schemes, particularly in the area of infrastructure funds, I think which the government has been attracting into, I think you are basically seeing a very large amount of long-term investment coming into the country.
Despite heavy FPI selling, the Sensex has managed a year to date gain of 4.8% on strong domestic flows. According to analysts, sustained FPI outflows could incrementally pressure markets going forward. However, the potential for incremental outflows could be limited given that FPI ownership of Indian equities is at a multi year low. So, how are FPIs likely to view India in the coming year? And how will the markets be affected?
So between the FPI and FDI inflow of money, I think India attracts somewhere around $100 billion every year. And I think this money could possibly go up only given the size of infrastructure projects that we are attracting world investors into. Last year, budget allocation was 7.5 lakh crore from the government side for spending on infrastructure. This year, given the kind of robust tax collection, my readings and stable commodity prices, my reading says that government may be encouraged to put more amount of money behind infrastructure, somewhere around 8.5 to 9 lakh crores. I think could be ultimately be allocated to the infrastructure. Now, if this is a situation, then chances are quite high that you are going to attract more amount of money from the FPI side, from the FDI side as well.